Greetings from 3Edge Asset Management. My name is Fritz Folts. I'm the Chief Investment Strategist here at 3Edge. Today is Friday, May 8th. We're going to do something a bit different today and combine our normal weekend update video with our monthly View from the Edge video podcast. To do that, I'm pleased to be joined here today by Eric Biegeleisen, Managing Director and Head of Investment Research here at 3Edge Asset Management. Eric, thanks for joining us here today.
My pleasure to be here. I can't imagine being anywhere else.
That's the spirit. So what we're going to do is a quick recap of the past week in economic and market news, and then we'll get right into our monthly View from the Edge report, and Eric will take us through our model research and what our model research is telling us about the 8 major asset classes that make up our investment universe, and importantly, what changes may have occurred in that outlook since April. As a reminder, all of our videos are on our YouTube channel. You can go to YouTube and search for 3Edge Asset Management. Don't forget to subscribe and select the bell icon in order to receive notification as our new videos are released. Also, please feel free to share these videos with anyone who you think might be interested in listening to them. So let's get started and let's talk about the markets.
Yeah, let's talk. All right, Fritz, what are we seeing in economic news thus far this week? How about the jobs number that came out?
That was just unbelievable. So as you said, today was Jobs Day, and the unemployment front, the news was frankly horrible. I mean, in the sharpest downturn for American workers in U.S. history, employers cut over 20 million jobs in April, and the unemployment rate more than tripled to over 14%. And Eric, the thing is, 2 months ago, back in February, the unemployment rate was around 3.5%, the lowest level in 5 decades. And now 2 months later, April unemployment is the highest since just after the Great Depression of the 1930s.
That's incredible, just incredible. So, markets are going up in spite of this awful employment print. It still seems like investors are confusing the market and the economy, 2 different things, right?
Absolutely. I think there's no doubt that investors right now are looking past the bleak employment news and they're looking towards the American economy reopening state by state here in the US. And I think just hoping that, okay, this report was really bad, but maybe it's the bottom. Maybe this is the nadir in terms of the economic slowdown.
Yeah.
And also, another thing that I think investors are looking at, and that was news from yesterday, that China and the U.S. have agreed to sit down next week to talk about implementing the first phase of the U.S.-China trade deal. And I think the market's like that. But one thing, Eric, that's interesting, and we'll get to it later when you talk about the different asset classes, but the bond market was even more interesting place than the stock market. Bond traders began pricing in the possibility that the Fed will cut its policy rate below 0, creating negative yielding debt. And we saw the 2-year U.S. Treasury go to a record low yield of around 13 basis points. So that's really crazy. So I'm glad you are here with us to sort all of this out. So let's shift now and look at the 8 major asset groups that make up our investment universe. And maybe we could start with the equity markets. What is our model research telling us about the outlook for the equity markets?
Yeah. So April was definitely one for the books, like we talked about. When you compare other significant market corrections, like say 1987 or even 1929, the rise we saw coming off the March 23rd low to the levels we are at now is, and I have to apologize in advance of using this word, but unprecedented. And I say that not because it's necessarily more or less indicative of where things are potentially headed. It's just incredibly noteworthy. I think the combination of whether reopening the economies will actually lead to economic growth, coupled with the notion of whether or not the government's stimulus, both monetary and fiscal, are enough to keep things afloat is really what the market is trying to assess currently, and probably more in the camp of that things are going to work out.
Looks like that for now. So let's just quickly break down then the 4 major equity asset classes that we look at and start with the U.S. equity market.
Yeah, so surprisingly, the outlook for U.S. equities actually hasn't changed that much from last month. We continue to find U.S. equities overvalued, which doesn't help the outlook. though we saw the massive widening in a number of credit spread indicators back in March, then recede in April, presumably on the back of the Federal Reserve's new ability to purchase corporate debt. So overall, we view U.S. equities as mixed. It wouldn't take too much of a push upward, though, from here, and we're already seeing some of that early days in this month, for the model to gain more confidence in this rebound, something we will no doubt be watching very closely.
Very good. And so then if we shift towards European equities, heading into April, our model research indicated that German equities in particular were an attractive asset class, and German equities did indeed have a strong month of April. So does that make them less attractive now as we head into May?
Yeah, it's an interesting one. So during the March equity market meltdown, and from a historical context, German equities had fallen much more than was rational by our measures. That is, they fell too far, too fast, too compressed a time frame. The model picked up on this, and despite this somewhat negative economic projection for German equities, behaviorally speaking, which is one of the edges of our investment approach, the model suggested the opportunity for a short-term rebound in April, like trying to catch a falling knife, which worked out well. Though following the rebound and with this behavioral catalyst no longer present, following the strong April performance that we just saw, the model is left only with that same negative economic projection on the asset class.
So less attractive.
That makes sense.
Yeah, very good. So last month, let's take a look now at emerging market equities, which were also on our radar screen as attractive looking into April. Has that changed?
Yes, it's a very similar story here with emerging market equities. That is, they were oversold and ripe for a rebound in April. Similarly, this reduced the EM equity projection somewhat, having that bounce in April. That being said, though, in the case of emerging market equities, and unlike as in the case of German equities, the model is indicating that there may be more room to run. So much as is the case with U.S. equities, we'll be watching this particular model particularly closely for signs that we should engage in a more meaningful way.
Very good. And then lastly, Japanese equities.
Yeah, we've said this for many months now. Japanese equities remain, very undervalued by our measure, and there still just has not been a catalyst present for us to get reinvested there.
Great. All right, so let's switch from stocks to bonds. And as I mentioned earlier, this week has been very interesting in terms of the bond market and the fact that bond traders now had started to consider or price in, if you will, the possibility that the U.S. central bank could cut its policy rate below zero. And we saw that really drag down yields in the 2-year at a record low of, I believe, 13 basis points. So what is our research currently indicating in terms of fixed income, not only rates, but also credit?
Yeah. So in terms of rates, or specifically the 10-year Treasury yield, which is what we're modeling, we haven't seen a huge change there in the rates outlook, which isn't too surprising, at least for the month of April that we would be examining, since yields themselves didn't move too much throughout the month. The projection remains positive, though, although less so as each month goes by, which is suggesting less and less appetite for longer duration treasuries, largely due to this massive stimulus and money creation without limit by the Fed's QE Infinity program. So the model, therefore, continues to favor a blend of shorter term and intermediate term treasuries. As for credit, the outlook does remain negative there, as the uncertainty surrounding the efforts of the world's major governments, monetary and fiscal authorities, and their stimulus programs work their way through the system. We just need to keep watching that to gain more confidence that these programs are going to work the way that they're intended to.
Yeah, that's right. I mean, we saw spreads widen out during the correction, and then they narrowed as the central bank's intervention kicked in. But something tells me that the carnage in the credit market isn't beyond. We're not beyond the carnage in the credit markets yet. But I guess we'll have to wait.
Time will tell.
Exactly. So let's look at real assets now. That would include gold and commodities, and let's start with gold.
Mm-hmm. Yeah, overall, though particularly in the medium to longer term, the model research is indicating positive support for gold, largely due to the massive intervention by the Fed that we've discussed. In the shorter term, the outlook is more mixed, as we've seen a positive shift in investor psychology for gold, as it has moved up to new highs briefly, though there remains some headwinds from the ongoing deflationary deleveraging by this slowing global economy and the need for certain investors to sell gold for liquidity purposes. something we saw on a more pronounced basis back in February and March. So generally speaking, positive on the asset class, certainly in the medium, longer term. Shorter term, maybe a little bit of caution.
Okay. And then let's consider commodities, which is clearly an undervalued asset class and maybe starting to become more interesting in terms of the model.
Yeah, you're right on. From a pure valuation standpoint, commodities do appear to be very undervalued from a longer term historical context, though it isn't yet clear that a catalyst has presented itself for reinvestment, something we're looking at very closely now. Shorter term, the outlook for global growth is somewhat uncertain, which wouldn't necessarily suggest now is a great time to buy, though this is actually one of the more active areas in our investment research. So we'll be watching this real closely to see if we can get that right.
Great. And then finally, we'll just take a look at cash and cash equivalents or very short-term Treasury market. How does that look for us?
Following the recent upward moves in the market and our subsequent rebalancing that we just did, we find ourselves again utilizing short-term fixed income and cash as an asset class to serve as dry powder to use for purchase of asset classes, ideally at lower prices in the future.
Great, thank you. So that's great. That's an update and insight into the major asset classes. And now, as we do each month in the View from the Edge video podcast, I'll ask Eric for his 3 most important takeaways from today's update. So Eric, what do you have for us this month?
Sure. Number 1, the April rebound was truly unprecedented and unlike any other such rebound in history. And our model research has reacted abruptly, doing an about face, particularly in the outlook for German equities, from positive back to negative. US and EM equities remain more neutral, and Japanese equities continue to have a negative outlook. Number 2, gold continues to have a positive outlook, given the shift to a positive investor psychology combined with Fed interventions. And number 3, commodities are a significantly undervalued asset class by our measure, and we are monitoring for the potential catalyst that will make the outlook shift to positive.
Great, excellent. Thanks, Eric. So that will do it for Eric and me here at 3 Edge Asset Management. Before we go, I have one important reminder, and that is that this Sunday, May 10th, is Mother's Day. So don't forget, you've been warned. As a reminder, all of our videos are available on YouTube. Please feel free to share any of these videos if you think that someone you know might be interested in them. And so from everyone here at 3 Edge Asset Management, we urge you to stay safe, stay strong, and keep the faith. Thanks for listening.
Thank you.